I'm honored to introduce Mr. Ashish Chauhan to this audience today. Mr. Ashish Chauhan is the MD and CEO of the National Stock Exchange of India and is definitely one of the most consequential Indians of our times. Previously, he has held several important positions, including being the CEO and MD of the Bombay Stock Exchange. He is currently a member of the university's Grant Commission in India. He's the Chancellor of University of Allahabad. And interestingly, he has also previously been the CEO of the Mumbai Indians team of the IPL. But today we are going to focus on his role as the CEO of the National Stock Exchange. And I am going to state 3 facts which will highlight why I think Mr. Chauhan holds one of the most critical roles in the country. It is under his leadership that NSE's market cap reached $5 trillion recently, making it the 6th largest stock exchange in the world. The number of unique registered accounts with the National Stock Exchange of India is more than 95 million today. So if just these investors were a country of their own, that would be the 15th largest country in the world. The NSE is also the world's largest derivatives exchange, and today we are in the presence of someone who is known as the father of modern financial derivatives in India. So welcome to Cambridge, Mr. Chauhan. India is at a watershed moment. Today, global capital is leaving countries like China and Russia because of geopolitical tension and political instability. My first question is, how well do you think India is positioned to absorb this capital?
No, thank you for calling me. It's an honor to be here at Cambridge. In some ways, the capital is required for any country to develop. And India was a capital-starved country for very long. We were a country which was poor per capita, but in some ways we were also saving a lot. Over the entire period since independence, we have been having the savings rate of almost 25, 30%, sometimes 35% across. And so we were saving a lot, but we were saving money in land or gold, which we could physically touch. We were not saving our own money into our companies, which create jobs and create further savings and so on and so forth. And that was the issue with India. Coming from abroad, say 94, 95, we started inviting money from abroad. And it used to look as if the foreigners have more trust in Indian corporate sector than Indians have, because Indians were saving less. Foreigners were actually investing more in Indian companies. And over the last 10 years, the situation has changed drastically. Around 10 years back in 2014, the foreigners owned, give and take 1%, around 20%, 19 to 20% of India's total market capitalization. That time, India's market capitalization was less than probably $1 trillion, 800 billion or something. Today, it is 5 trillion. And there, the foreigners owning stock has now gone down to around 16.5%. So on a larger base, their holding has actually come down because more Indians are saving more of their money into Indian stock market, which is a heartening thing. That doesn't mean India should not welcome the foreign capital for its growth. And that's where if people are not investing in China or they are not investing in other places, they will have their own reasons. And India, why they need to invest in India or why they would invest in India is because of variety of reasons. Why Indians are investing in India is also an interesting thing. Because there is an economic theory, and there are books written on that, that poor people, because India is still a reasonably poor per capita income country, we are just below $3,000 per capita for students to know, which is not very large. And the economic theory says that the poor people don't save first because they have to spend a lot of money. And even if they save, they don't invest into other people, including their brothers and sisters. Why would they invest in completely unknown people? And that's where basically India, over the last literally 150 years since the first exchange started, but last 30 years, has belied that economic theory. India is an outlier. It is amongst the lowest per capita income country, but it is now the fourth largest market in terms of the market capitalization in the world after US, China, and Japan. So effectively, a poor per capita income country having poor people investing small little amounts like $10, $20 into companies which they are never going to visit. A person sitting in Jammu or Srinagar or Dibrugarh or Jorhat, which are like 2,000 kilometers from Chennai, those people are putting their hard-earned 1,000 rupees or $10 or 10 pounds into that company. They are never going to visit, but they have complete confidence in that entrepreneur who is running that business, saying that when that person will use that money for creating surpluses, and when surplus happens, he will not siphon them away. And then, of course, they have complete trust in India's judiciary, India's parliament, India's lawmakers and regulators and ministries and, of course, exchanges. But more importantly, now India has started trusting its entrepreneurs. And what I say is that India has become a very trustful nation. Literally 100 million people, as she said, 95 million people alone with NSE, and if you take other exchanges probably, and also mutual funds, we have like 100 million people investing directly. That is 20% of India's household. 75 million households, 20% of India's households, which is a very large leap of faith that India has taken on its entrepreneurs. And for me, why it has happened is because of our corporate governance. Of course, we are the best and the brightest in terms of the transaction processing. A stock exchange does two jobs. One is transaction processing, that is buy, sell, all those prices go up and down, and that's very exciting. Many people come into stock market for that. But the more important work it does is basically getting the investors to meet the companies, channelizing savings of the households into productive capital of the companies. And that's where today India is having the best corporate governance framework compared to anywhere in the world. Last year, you might have heard of bad corporate governance in India. You can ask Dr. Hamid. But any capital markets person you sit in, say, ask in America, every investor, because ultimately investors are asking for protection for their money. And America has what they call golden share, where one single person with one share can still override all other shareholders. It is not good corporate governance. In fact, for me in India, all shares traded, other than probably one or two companies, all shares have the same value in terms of the voting rights, what we call pari passu in legal terms. And that is what I call the best corporate governance. There is another framework we have created, is called majority of minority, which is that if the management has an interest or dominant promoter or dominant entrepreneur has an interest in a particular resolution, that resolution he or she cannot vote for. So the remaining minority shareholders only will vote for that particular resolution. It's a brilliant way to bring the corporate democracy in play. And that's why India today, over the last 30, 40 years, has become very, very impressive in terms of thought process of how to protect minority interest right. And that is where why Indians are trusting Indian entrepreneurs. And I'm sure the foreign investors also, when they come to know of this, they will trust Indian markets more. And that's where, if you see, again, there is another framework. Yesterday night, after coming here, I tweeted that in 1995, I started an index called Nifty, which is now the largest traded index in the world. But in 1995, I think November 395 was the base, it was 1,000. But if you take it on a dollar basis, compare it with, say, S&P 500, on dollar-to-dollar basis, that $100 if you had invested in Nifty, today it will be some 971 vis-a-vis the S&P, which will be in somewhere around 811 or 820. So effectively, on dollar terms also, Indian markets has given much higher returns than American markets. And American markets are supposed to be the best returning markets in last 30 years. On dollar terms, we are larger returning markets. And that's why last week in one of the conferences, I said that America needed Mr. Warren Buffett, India needed Nifty. And basically, that's where, if you look at it comparison-wise, in China, 30 years back, if you had invested $1,000 or $100 in China, it would be probably $100 now, if you look at their index. Because when an economy, when regulators don't protect small investors' interest, which means the promoter's interest or the manager's interest are more taken care, then slowly the returns that are available to the investors go down. And that's where, basically for me, that is one portion of the overall equation, which is great corporate governance, great transaction processing part, and third part, which I, in a way, have created in my own mind a framework saying, earlier, if you had to put in a lot of money, you required a lot of money, which is the capitalism, right? Capital is required to create more capital. That was the Karl Marx who created that idea, sitting in London, by seeing people working in abject poverty in industrializing London of those days. And that's where he said that you require more capital, and that is where the capitalism versus communism started. Before that, there was no concept of capitalism. But India was always starved of capital post its independence, and of course, pre-independence. Today, with the technology, the way it has evolved, you don't require a lot of capital to create more capital. You require a little bit of capital, and by quirk of fate, India has already reached that level that it's able to save itself and put in money in its own businesses. And that's where what I call is that the new capitalism is capitalism with less capital or zero capital. And that's where Indian newer youngsters, and Mr. Hamid actually invited you back, many of you, to come back with technologies, start your own businesses. In his time, it used to require a lot of money to start businesses. In your time, it doesn't require a lot of money to start your own business. If you don't have money, other Indians are willing to invest in you. So come, India is open for business. Create those businesses where little bit of money, lot of exposure, lot of ideas, lot of hard work will create more money. And that's where, for me, this capitalism without capital, the newer model using technology to create more businesses and great wealth, like Infosys. Those people, Nandan or Narayan Murthy, they did not come from business families. They did not have any background. They were just engineers, started their own firm with very little capital, and now all of them are worth tens of billions of dollars, right? And that is true with a Zerodha person or Zomato person, or there are like now 100 or 1,000 role models for all of you to actually go with, saying, that's where, for me, the rest of the world is currently investing more in those youngsters and young businesses, but Indians have started investing, and that's where more and more capital, or less capital, but potential to create great capital or great wealth is actually coming into India.
Thank you for those insights, sir. Thank you for those insights, sir. So you have played a crucial role in implementing advanced trading technologies at both NSE and BSE by setting up screen-based trading, mobile trading, mutual fund distribution through the exchange, and also the Nifty index, and much more. With now the emerging new technologies such as AI and quantum computing, how do you perceive investors' trading experience to be changed?
In a way, if you look at, say, speed-wise, see, there are, what we need to do conceptually at stock exchanges, we provide you transaction processing platforms. So you place a buy order, and somebody else places sell order. I need to match it correctly. So if you want to buy at 100, which means you want to buy at 100 or below. At 99, you are happy. 98, you are even happier, and stuff like that. And if you want to sell at 100, you want to sell at 100 or above. If you get 101, you are happy or happier. At 102, you are even happier. Stuff like that, right? So in some ways, that's what the stock market does. When it used to trade on a floor like this, it still had the same purpose. When it trades on the screen, like the way NSE does, it has still the same purpose, to give you the best price at the fastest possible way. Today, Indian stock markets give you response time of microseconds. In 1 second, there are a million microseconds. Just to give you a perspective, what is a second and what is a microsecond? It is the same difference between 1 day and 3,500 years. So if you say, I will not take a decision today, vis-a-vis sort of tomorrow, as if you have passed the entire civilizational process, right? And that is the difference between microsecond and seconds. And second itself is very difficult to operate on. We operate at microsecond levels. And the number of orders, number of trades we get are numerous because Indians are very good at machines, at computers, at mobiles and all. So on a good day, like on June 5th, 2024, just next day to the election counting day, we got 19.7 billion orders in 6 hours. That is like 15 orders per Indians in that day, right? And we had around 280 million trades. That would have been probably 40–50% of all trades in the world on that day. Why I'm telling you this? But each trade has very, very little value. So it could be in equities, it could be, say, $100 or something like $150. In derivatives, it could be even, in options, it could be even 1/10 or 1/20th or 1/50th. But small little players, it's a classic economic, right? That small little players are putting lots and lots of economic agents are independent and they're placing orders. So that's what the stock market does for you in India. And across the world, it's slowly going to happen because earlier the markets were more institutional in those countries. But technology now allows everyone to trade, and you have seen some sort of gamification in America also that is happening. But India has been kind of at the forefront for last 30 years on automation and things like that. And so that is what we need to do. We need to do risk management on real time, on clearing, settlement, and all those things for you. And so this billions of dollars of trades, we need to ensure that they don't fail. We have to keep on giving you money in time. You have to take your money in time and things like that. So that's what our main job is. And in terms of the future technologies, say AI can be used in every part of it, every part of decision-making process for the investor, but also at the exchange end. Only thing what we cannot do is in the matching. Because in matching, I need to give you a deterministic answer. If you want to buy at 100, I cannot make you buy at 101. Whereas today, if you have seen all the ChatGPT 4.0 or whatever comes, all of them hallucinate, right? They may end up matching you at higher price also without explanation because it learns and tries to do things, right? Whereas here, humans expect complete clarity, no new learning, right? And that's where, but in terms of giving you answers to your questions, in terms of your information about margins and other things, we would be able to do it. Similarly, quantum computing has its own sort of many ways of being used once it starts becoming commercially viable for people. And one of them is in the cyber security. It is more to do about breaking the code rather than making the code, but it can actually be used for making the code too. And so we will be at top of any technology that comes, which becomes commercially viable, available. And that's where NSE has been at the forefront over the last 30 years, since it started in November 394 on equities. And all 30 years, we have been the best in terms of the trading volumes, in terms of risk management, clearing, settlement, and we'll continue to do that. But whichever technology comes, we will continue to explore, use them in possible areas which we need to sort of keep on doing.
Thank you so much for your response, Mr. Chauhan. My next question is regarding IPOs. It is one of those aspects of Indian capital market where we have covered significant gap. For instance, in the past 5 years, 5 years ago actually, India was not even in the top 10 countries in terms of IPO proceeds, and now it's the third largest, I guess. I would love to hear from you on what India should be doing now to develop as a premier location for global IPOs, especially for companies from the West and elsewhere.
Yep. So in some ways, the IPOs in India have been numerous, although per IPO we actually raise much lower numbers. So India has been IPO capital for very long. because Indian businesses have understood that private equity or venture capital or angel funding is available to very few people. Although when you read newspapers, you think almost everyone gets funded. It is not true. Most people don't get funding. And that's where many of them are now coming to the markets, raising even as little as $1 million or $500,000, and creating those companies. Some of them are becoming large and things like that. So India has had a different type of capitalism, as I call it, over the last 30 years, and it has evolved. But average raise on a even main board has come down from, there are companies which raise even $2 billion or $5 billion, but there are companies which raise even $100 million on main board. And so India always had large number, but what had happened is other countries like China or Hong Kong, which is actually now part of China, used to have IPOs which used to raise huge, humongous amounts, and they had become very large in a short time. That's where India was kind of overshadowed. Last 1 year or 2 years, China is not doing so well in terms of the many other things, including in IPO. Even Hong Kong is not doing so well. So you can see that India, the number of IPOs, India does pretty much the largest number because we have too many micro companies coming. But even otherwise, India is now in top 2, 3 in terms of the raising of funds. In terms of getting foreign capital to, foreign companies to come and list in India, India is a capital control economy. That is, Indians cannot invest abroad beyond a particular size. So we do not have any companies which are not registered in India. There are multinationals which are registered in India, like Siemens or Livers. Their subsidiaries are listed in India. But it's not that the foreign companies have listed in India. It's their subsidiaries in India which have listed. And Indians are not allowed to go above a particular size of capital export per year. And that's where most Indians don't prefer to invest abroad. Now, slowly, mutual funds have started investing abroad in foreign companies. But we have also created a new platform called Gift City in near Mumbai, around 500 kilometers from Mumbai, in a state called Gujarat, where it's a dollar-denominated area, a small little area, but it's an international finance services center, where an Indonesian company would be able to raise funds from, say, Gulf investors or Canadian investors. And that is what that Gift City, of course, Indian companies also will be able to raise funds from there, but even foreign companies would be able to raise funds from foreign investors. And that is going to be a more interesting aspect. The new direct listing norms are going to be implemented in next 1 or 2 months. And that's where company, which is, say, structured in Singapore or in US, but has business in Asia or in Africa, they would be able to come raise those funds. That market, which is NSE created market called NSE IX, NSE International Exchange, works around 21.5 hours every day. So before Japan wakes up, it starts trading. And before after California sleeps, it goes to sleep. So effectively cover the entire trading time for all the markets. So even an African company would be able to have its investors trade, but Japanese investors would be able to trade in American companies and so on and so forth. So that's basically the market we have created. We already have a very large trading volume happening on what we call Nifty, which is overseas Nifty. There are people who used to trade in Singapore. Right? It used to be called SGX Nifty. Now that has become a Gift Nifty. And daily, on a good day, we would get $20 billion of trading volumes, $20 billion of open interest and things like that. So it's an early days, but it's a very promising market. So if the foreign companies, because what has happened today is to stay listed in America or even in Europe or in London, you need to spend a lot of money as a company to stay listed. Whereas India is a very tough jurisdiction in favor of the non-promoter investors, but the cost of listing is extremely low, close to zero, on an every year basis. And that's where many small companies below a particular size cannot remain listed in America or in Europe for that matter. But all of them can come and list in Gift City. That is my hope, that the methodology we have developed of low-cost capital market infrastructure, if you can provide to the world, then world will be able to use that for their own benefits.
Thank you, sir. Now, with the implementation of the e-IPO system, participation in IPOs has become relatively easier and more effective. How do you see future innovations such as decentralized finance or DeFi impacting the IPO market and capital raising?
In a way, there are many questions into one. The IPO market in India is done through now screen. And so in, again, most other markets, the investment banker actually distributes, they collect the IPO demand from their customers, and then they price it and distribute to people who they feel like will hold on to those shares after getting that. In India, it has been democratized to such an extent that every category of investors, that is small, large individuals, small individuals, large individuals, Indian institutions, foreign institutions like that, each category of investors need to apply on the screen, and they will get on a random basis, if it is oversubscribed, the allocation. So it's not given to the favorites, but to everyone. And the scale and size is again unheard of in the world. On a good IPO, like LIC, which is Life Insurance Corporation IPO, we got 7 million applications. Right? So almost like Switzerland's population. And so that is where basically the numbers are way, way above anything. In terms of giving comfort to every type of investor that he or she will have the equal chance vis-a-vis other people of getting that IPO share is very important, because you need to give that comfort and fairness, transparency to the public. Having said that, DeFi, or what we call blockchain, which is used with variety of other words, has its own sort of use cases, which they keep on telling you that we can solve this for you, we can solve that for you. But broadly speaking, they're trying to solve what is already solved. As I told you, in Indian markets, we have solved cases where 7 million people are investing in IPO, and if there are 70 million also, or 700 million, we should be able to do it within sort of no time at all. And if you have to allocate and get shares, again, we should be able to do it in few minutes or a day at most. People tell me that, no, but if you use blockchain, you will be able to do it within a day. But today, I do T+0 settlements in India. We were the first to go T+1 in the world last year. Now we have started doing T+0, and now talks are there to do instantaneous settlement. So what you think you will promise me from a great so-called technology, I do better than that now on a scale which cannot be done ever in that technology, right? So broadly, at the same time, once it starts becoming useful and solves newer problems, of course, we will explore that. But currently, we think the people who have made money out of cryptos are trying to project that as a sort of panacea for all the ills in the world, including cancer detection or cancer sort of cure and stuff like that. Hopefully, it will be able to do. But as and when it becomes useful, we'll use it.
Thank you, sir. My next question goes back to your comparison between Nifty and S&P 500. I found out that the price-earning ratio of Nifty is now the highest in the world and is at par with S&P 500. So the price-earning ratio being high can be an indicator for two things. Either the market is overvalued or the growth prospects are very high. And the same thing for undervaluation. If, like in the case of China, it can indicate the market being undervalued or very low growth prospects. Where do you think the Indian capital market stands in this matrix?
Broadly speaking, although I don't invest, I'm not allowed to invest. I mean, I'm more what I call a plumbing guy in your house, which you usually don't want to see, or umpire in a cricket match who is there. Nobody wants to see his face, right? That is my job, but I can still tell you that who plays well. That doesn't mean who will actually play well. And so if you look at the history of the capital markets, say Japan's history in 70s and 80s, or China's, you can even Korea's. When the country is on a growth trajectory, which is faster than the rest of the world, the price-earning ratios are higher because the expectation of growth in corporate earnings is higher, and normally the profits then catches up the value. When the country is not on the great growth trajectory, the price earnings actually come down drastically, which happened to, say, Japan post 1980s. In 1988 or 89, I think they had Nikkei, which had gone up to probably 40,000 or something. And next 40 years, they didn't. And that time, their price earnings ratio had actually plummeted. Today, you can see it in China. China's price earning ratio is very low now because people are expecting those companies, although they may be large companies, not to grow at that rate, which they were growing over last 20, 30 years. And that's why their price earning ratio has actually come down. The other side, Indian price earning ratios are higher because of two reasons. One is that the people's expectations of growth in India is higher. The second is that India is completely deleveraged country. If you look at the banking system size of China vis-a-vis their entire GDP, it's around $18 trillion. What is their banking system size, which is somewhere between 65 to $72 trillion. That's like 4:1 leverage on banking alone. Then shadow banking and other things is different. Even America is hugely leveraged on their size of the economy. In India's size, on a $4 trillion economy today, my banking system size is $2.5 trillion. It's an extremely conservative banking system, and that's why it has a great sort of room available to finance the growth of the country going forward without any accidents. And those are the reasons why people feel that India deserves a little bit of premium. It's not great premium, but a little bit of premium on growth prospects going forward.
Thank you for the insightful discussion, sir. Now we'd like to open the floor for audience Q&A. Although we encourage everyone to participate actively, we request you to remain relevant to the theme. Yes.
Hello, sir. My name is Ashish Dikshit, and I would first of all like to thank you and the National Stock Exchange, because I'm personally a beneficiary of the spectacular growth that has happened in the past couple of decades or so. And it's heartening to see that so many Indians are trusting in the entrepreneurs as well as in the institutions, as you pointed out. But when something like the Hindenburg report came out, there was silence for some time, and there was a perception among a section of investors that there is reluctance on part of the government as well as the regulator, SEBI, to take some action against Adani. So do you think there should have been swift investigation or at least swift communication to maintain the trust we all have in you? Thank you.
It's a good question. Why? Is because a thief calling a good person a thief. And then you need to, it's literally somebody called Hindenburg whose avowed job, it's not even a secret job, whose avowed job is to actually short sell and make money out of taking down the price of a particular stock, right? They create reports, good, bad, ugly, correct, incorrect, on many companies. I think when they came out with the Adani report, it was their 20th report. 19 reports were on American companies. None of us mentioned that American government took any action on those 19 guys. Because American government is mature to understand that this guy's job is to create nuisance. It is now. We have been made to believe that whatever comes of America, even from a thief, a short seller, I wouldn't call him thief, but short seller, must be true. And that's why, irrespective whether the person who has done wrong or not, must be taken action against immediately, instantly, because it has come from America. This is what I call a privilege of rich people. Their corporate governance is extremely bad, let me put it that way. They have golden shares, they have shares with more rights than others, and so on and so forth in public markets. It is, I keep on saying that we still need to tolerate this, and we must to come out. We cannot say no, but we need to continue to improve our corporate governance standards, which we continue to do. Ask Mr. Hamid how difficult or how tough it is to be governed in India vis-a-vis in any other country from corporate governance perspective. But we are still per capita poor income country, and we have to still take short sellers' acquisition from America as gospel truth, and India's lived experiences as bunkum, right? So I hope this is what, and sitting here, don't believe all the stories that come against India. That doesn't mean don't believe all the good stories also, don't believe all the bad stories also, right? Somewhere, use your own judgments. And it doesn't mean investigations are not happening, they have happened. You have seen the outcomes, Supreme Court had taken notice. And again, if you were a student of finance, probably you are not, you would have gone through allegations. There were 88 allegations. People were trying to make you believe that today's regulations have to be applicable to something that happened in 2002. And so on and so forth. So try studying that, although it's easy to just take something coming from wherever and take it as gospel truth, right?
Thank you, sir. We'd like to take the next question.
Thank you. My name is Ketan Deshpande, and I'm a fellow here at JBS. My question was about the new vision which Social Stock Exchange has come. What is some of your vision in bringing this new movement for non-profits and social enterprises? If you could throw some light on that.
Thank you. It's, again, an interesting framework. It was announced by India's Finance Minister, Madam Nirmala Sitharaman, in 2019 budget speech. So it's her vision that she wanted to bring that transparency that is there in India's stock markets, in corporate governance, onto the NGO sector, or non-governmental organizations in the social sector. And that's why she announced that. It took us some time because she gave it a name, Social Stock Exchange. And so it had to be regulated by SEBI. And for a regulation to happen by SEBI, whatever instruments you do have to be securities, because it's actually Security and Exchange Board of India, right? So it had to be created into a security. Committees were set up to figure out how to regulate that market, but also how to create a security, which is actually a donation, but effectively it looks like a security. So kind of a zero coupon, zero principal instrument was developed, which is a security, but it's actually a donation. And this year, after almost 5 years, we could garner some of the NPOs, as we call it, NGOs, who list with us, have raised funds. I think 7 or 8 of them have raised funds, totally around 10 crore, which is like $1.2 million. One more NPO has filed for $1.2 million single. And so it's an interesting framework to bring transparency to the workings of the social sector. And then there are outcome-based financing-related activities that are going to also be added later on and all. And that's basically a very interesting way to bring public transparency to inherently a social sector, which in a way is supposed to be transparent, right? So you raise the funds, but now onwards you have to also give information back, whether you met your objectives on a periodic basis, how much you did and how much money you spent and those kind of things. So what happens in the public limited companies, that is listed companies, in terms of quarterly results and all, not exactly, but something similar is actually on the offering for the social sector.
Thank you, sir. One more question, please.
Hello. I'm Ravi More. I'm working as a research associate in Department of Pediatrics, University of Cambridge. Sir, my question is related to fractional shares implementation in Indian stock market. As a small retail investor, we find the limitations to diversify our portfolio and investment. So I'm not able, for example, I'm not able to buy share like MRF. So what is your vision for fractional share implementation in stock market?
So fractional share for uninitiated people, suppose a share is trading, say, at $1,000. You can't afford $1,000. So you divide into one share into, say, 100 parts and make it 0.01 share. And that's called fractional share. So it's required in economy, which is basically having large lots or large share prices. At the same time, there is a requirement, it is happening in other countries, so Indian regulator is also thinking, as and when they come to a conclusion and create regulations, you will be able to do it. But having said that, there are not many companies in India which have more than, say, $10 or 800 rupees as price. If you want to invest, say, one share, you are able to buy in 800 rupees also. But most companies will have share prices between, say, 10 to 200 rupees, which is like less than $3. If you want fraction and hundredth, then you realize the cost of transactions might be higher than the cost of the share and stuff like that. So effectively, it is, because it is done in the rest of the world, good to do. I don't know the efficacy.
I'd like to take this opportunity to thank Mr. Ashish Chauhan for sharing your profound insights and experiences with us today. Your contributions to the evolution of the Indian stock market and your vision for the future is truly inspiring. And to our audience, thank you for your active participation and your questions. Now, we